If you bought in 2024 and most of your portfolio is in altcoins, chances are you're still underwater or barely at break-even. And honestly, that's not a skill issue. This cycle has been brutal for altcoins. Their performance has been so bad that many are starting to wonder if we'll even get a proper alt season before this cycle ends. If your altcoins have done well, you should be proud, because you've probably picked from the top 5% of projects. The other 95% have been absolute garbage. You buy the dip on your high-conviction altcoin, only to get hit with another dip even deeper than the last one. So the critical question is, will this misery even end or altcoins are cooked this cycle? In this video, we're going to break down exactly why this cycle isn't playing out like the ones before it. We'll analyze data from past cycles, uncover the big structural forces driving today's market, and share a fresh playbook to help you hunt profits in this new environment. If that sounds good, smash that like button to support the channel. It really helps us keep putting out no-nonsense content. And if you haven't subscribed yet, make sure you do so you don't miss the next update. Let's get straight into it. To understand why this cycle feels broken, we first need to look at how previous cycles played out. Historically, crypto followed a fairly predictable flow of capital. It always started with Bitcoin, where capital would flood in, driving both price and market dominance higher. Once Bitcoin cooled off and started consolidating, profits would rotate into ETH, the next largest and most trusted altcoin. From there, money would flow into large-cap altcoins, then mid-caps, and finally spark a speculative mania in small caps and meme coins. This final phase, where nearly every chart turned vertical, is what we came to know as Altseason or banana zone. The first major Altseason was driven almost entirely by retail speculation, fueled by the ICO boom built on ETH. Thousands of projects launched during this period, raising money directly from the public by issuing tokens. The single most defining feature of this cycle was the massive collapse in Bitcoin dominance as capital rotated down the risk curve. In late 2017, Bitcoin dominance was above 86%, but as capital poured into the ICO craze, it collapsed to just 38% by early 2018. It was a market where a rising tide lifted all boats, even the ones that were sinking or outright scams. The 2021 cycle brought a new set of narratives that captured the market's imagination. Decentralized finance, NFTs, and a fresh wave of meme coins created explosive speculative energy. This was amplified by unprecedented macro conditions like massive government stimulus, near-zero interest rates, and record liquidity flooding the global economy. While the themes were different from 2017, the underlying dynamic was the same. Bitcoin's dominance once again broke down, dropping from nearly 70% to 38%. The altcoin season index even hit a euphoric 98, confirming what everyone already felt. It was a full-blown alt season. The 2025 cycle has been awful until now. The numbers don't lie, and they're painting a picture that most retail investors don't want to face. Bitcoin dominance has been stuck in a yo-yo range between 58% and 65% throughout 2025. In past cycles, this would have been the perfect setup for explosive altcoin rallies, but most alts are still struggling just to retest their December 2024 highs. The altcoin season index even hit 80%, technically signaling alt season, yet the majority of investors are still licking their wounds after months of grinding sideways or bleeding lower. So what is different this time? The game itself has changed. The players are different, the rules have shifted, and the playing field is no longer what it used to be. There are three powerful structural forces at work that have completely disrupted the old cycle playbook and made this market a brutal test for anyone still fighting in the trenches. Firstly, the ETFs are acting like a massive liquidity black hole. The approval and launch of spot Bitcoin ETFs in the US was a true watershed moment for the industry. These products have been wildly successful, pulling in over $36 billion in net inflows within their first year. But this success came with an unintended side effect, a liquidity vacuum for the rest of the crypto market. Most of this new capital comes from institutional and traditional finance investors who prefer the safety of regulated ETF wrappers. These funds buy and hold Bitcoin on behalf of investors, giving them price exposure without ever touching an exchange or interacting with the on-chain crypto economy. The result is a one-way flow of money that pumps Bitcoin's price but never trickles down into altcoins. This ETF structure has essentially severed the link between Bitcoin inflows and broader market liquidity, breaking the old capital rotation model that historically kicked off alt seasons. The second major force is the sheer scale of institutional adoption. A 2025 EY survey found that 86% of institutional investors already have exposure to digital assets or plan to make allocations this year. Even more telling, 59% of these firms intend to allocate over 5% of their total assets under management to crypto. This wave of professional capital brings an entirely new mindset to the market. Unlike the retail-driven speculation of past cycles, institutional capital is conservative by nature. These investors favor established, liquid, and increasingly regulated assets like Bitcoin and, to a lesser extent, ETH. They are not chasing speculative, low-cap altcoins. Their presence acts as a stabilizer, muting the wild volatility and sharp price swings that once defined crypto cycles. This flight to quality concentrates liquidity at the top of the market, leaving far less to filter down to the thousands of smaller projects that once thrived during alt seasons. Finally, the global regulatory landscape is maturing. Jurisdictions worldwide are moving from ambiguity and sporadic enforcement to establishing clear legal frameworks. Like the MiCA regulation in the European Union and ongoing collaborative efforts by the SEC and CFTC in the United States. This evolving regulatory environment acts as a filter for the industry. It creates a two-tiered market where projects with clear value propositions, transparent operations, strong development teams, and a path to compliance attract serious institutional capital. At the same time, projects that are purely speculative, anonymous, or operate in legal gray areas are increasingly sidelined. This filtering mechanism further concentrates capital into a smaller group of investment-grade assets, preventing the broad, indiscriminate rallies that once fueled full-cycle alt seasons. This table highlights the evolution of crypto bull cycles, emphasizing the key differences that define today's market. Given these structural shifts, my view on the Bitcoin cycle has remained consistent. The traditional 4-year crypto cycle is either dead or, at minimum, undergoing a major extension. The once predictable boom and bust rhythm linked to Bitcoin's halving events may no longer be the primary driver of the market. Don't just take it from a random person on the internet. Prominent market observers have presented strong cases for this extended cycle thesis as well. Matt Haugen, CIO of Bitwise, has stated that the 4-year halving cycle is dead. He points to the growing institutionalization of the space, a more favorable interest rate environment, and improving regulatory clarity as forces that override the old patterns. Haugen expects the bull market still has room to run, even predicting 2026 could be an up year for Bitcoin. Similarly, Rael Pal connects the crypto cycle to broader business cycles and global liquidity, arguing that slow economic expansion is stretching this bull market into 2026. Arthur Hayes also provides a liquidity-driven perspective, suggesting a later market peak, potentially around March 2026, followed by a correction. The implication of these theories is that the market is likely to see a longer, more sustained, and steadier boom rather than the short, violent blow-off top that defined previous cycles. This means the euphoric market-wide banana zone is unlikely to appear in its historical form. Instead, the market will likely move through what can be called banana patches. Intense, isolated, and narrative-driven rallies in specific sectors, while most other assets lag behind or even decline. This new reality requires patience. Life-changing gains are still possible, but they will not come from simply buying a random basket of 25 altcoins and waiting for the tide to rise. So what's the new playbook? In this evolving market paradigm, the winning strategy is no longer to wait for a broad-based alt season. Instead, success comes from actively hunting narratives. This approach, known as narrative rotation, involves concentrating capital in a select number of tokens that align with the market's current hot themes, stories, or trends. In this cycle, capital follows attention, and attention is captured by compelling narratives that resonate with the new institutional players. Navigating this narrative-driven market demands a disciplined mindset and a fresh set of tools. Here's a practical playbook for thriving in a cycle that is structurally different. Firstly, become a narrative spotter. Learn to identify emerging trends before they hit the mainstream. This requires monitoring the flow of attention and capital using multiple tools. Platforms like CoinGecko and CoinMarketCap provide categorized token lists, making it easier to track sector-wide performance. Social media trend trackers and sentiment analysis tools give real-time insight into which narratives are gaining traction. Sentiment is especially useful here. Dedicated crypto research platforms like Messari provide detailed analysis of emerging sectors, giving an extra layer of context. Secondly, follow the smart money. On-chain analysis remains one of the most powerful advantages in crypto, letting anyone see what is happening at the network level. Advanced platforms like Nansen and Arkham Intelligence go further by labeling wallets, allowing you to track institutional funds, venture capitalists, and influential smart money traders. Seeing where these sophisticated players are accumulating provides a strong signal of which narratives have real traction. Next, prune your portfolio. Broad diversification is no longer effective. Holding 25 or more altcoins is a recipe for underperformance in this cycle. A better approach is a concentrated portfolio of 5 to 7 high-conviction assets across 2 to 3 strong narratives. Be ruthless about selling outdated or irrelevant coins that no longer fit the market's current story. Finally, master rotation and risk management. Narrative hunting is active, not passive. It demands discipline and a clear plan. Set defined profit targets and use stop-loss orders to protect against downside. Avoid getting emotionally attached to any single project or narrative. Be ready to rotate capital from a narrative that is peaking into one that is just gaining momentum. This dynamic approach is essential to capture gains in a market defined by rapid shifts in attention. The altcoin season of 2025 will not resemble past cycles. The old map is obsolete. The market has shifted from a retail-driven lottery to an institution-led game of chess. The fire hose of capital that once lifted every project has been replaced by precise streams of money targeting specific, high-conviction narratives. Opportunities are still life-changing for those who adapt, learn to spot trends, follow the smart money, and manage risk like a pro. The euphoric gains are still out there. The banana zone still exists, but now it must be hunted one patch at a time. If you found this breakdown helpful, smash the like button to support the channel and make sure to subscribe. Thank you for watching, and I'll see you in the next one.